About the broader trends which are taking shape in the market with Prasun Gajri also joining us now on the show. Prasun, afternoon. Last 1 year when economic data and indicators were not very good, the market was galloping ahead of all of that. And now when, the economic indicators have started improving a whole lot, corporate earnings third quarter, fourth quarter in a row are actually bulk of them are in line with estimates, and the estimates themselves are strong in the first place. It appears that market is taking some time off. What is your observation?
No, I don't think there's any surprise in that, to be honest. So clearly, when the markets were moving up, we were seeing constant earning upgrades. For 2, 3 quarters in a row, we saw earnings upgrades. For the last 2 quarters, the earning upgrades have stopped. So we are pretty much seeing earnings coming in line with whatever assumptions the market had. So I think that is one. So you stop seeing earning upgrades. So that is one area where one has to be a little bit cautious about. The other piece is, while the economic data is turning out to be positive, that also means, along with that, we are seeing inflation. Yesterday's print in US is obviously a little bit worrying from markets perspective and puts into question whether this high inflation trajectory is transitory or does it have a more permanent angle to it, at least. So what that brings into question is the accommodation the central banks will have. We have seen unprecedented accommodation by the central banks across the globe. Now, this kind of inflation numbers and reasonably strong growth could mean that central banks start pulling back on the accommodation. We've already seen tapering starting, though that has been well broadcast and the numbers are very much in line with what the market anticipated. So there has been no big market reaction as was anticipated. But overall, I think these are some of the worries markets have. And given that, I think the markets are in a range bound situation. And also, I believe this is healthy for the market. I mean, you cannot have a one-way street in the market with the markets keep moving up. That is not healthy for the market. Some sort of a consolidation is always welcome, and I think market is going through that phase at this point of time.
Prasun, highest inflation in 3 years. Also, at the same time, I mean, we all were surprised why US markets didn't really crash big time. But at the same time, the contributors or the calculators of that number, all the key commodities barring oil, have actually eased off. Shipping freight rates have come down in the last 20, I would say 15 to 20 days, 20 to 30% easing off. So peak inflation perhaps maybe behind. What is your view? All that disruption is normalizing now?
But on the commodity side, we do sense some sort of normalization happening. Even on the freight rates, we are starting to see normalization happening across the globe. However, on a year-on-year basis, it's still pretty high. I think what the challenge is that so far market does believe that this is transit. Question is if it sustains at these levels, do the market assumptions change? So I think there is that bit of fear. So I think that is keeping the market in balance. We're not seeing a big correction, but at the same time, you're starting to see a bit of cautiousness emerging in the market. So that is the way I think it is going to be balancing out in the short run till we get a little bit more conclusive evidence of which way we are heading for on inflation, interest rates, and the central bank action.
Prasun, where do you stand on the argument that even if some inflation comes back, actually it will be good news because it, actually confirms that growth is coming back. Also, on the point that the way capex cycle is taking off in India, corporate balance sheets are healthier. We may be looking in for 3 to 5 year economic expansion, and within that there would be phases where market would be ahead of fundamentals, and then there would be phases where numbers are ahead and markets are languishing. But the larger picture appears to be setting for a 3 to 5 year economic expansion, if not more from here.
Well, that's clearly a bull argument, and I would believe that partly it could be true, but I don't see complete evidence of that as yet. See, clearly, the signs of corporate capex are not visible as yet. Some minor signs, but in totality, we are not seeing anything in terms of the bank credit growing or large scale capex coming through. So that is not happening. I think one has to be cautious in terms of how things pan out in a situation where energy prices have risen. Even if they kind of stabilize at these levels, that is not very good from a Indian economy perspective. Third, I think the assumption is that this pandemic is completely behind us and there are no after effects of the pandemic on the overall consumption, etc. I would kind of reserve my judgment on that. I think one has to be a little bit cautious on that front as well. So while we could see some sort of an expansion in the economy, I would reserve my judgment whether it's going to be a large-scale, multi-year kind of expansion, or whether it is going to again be a little bit more varied and volatile kind of an expansion. We already know that there are certain segments of the economy, there are certain segments of the population which have suffered significantly. How they behave over the next couple of years remains to be seen. So I do not quite share that kind of unbridled optimism. At the same time, I think we will continue to watch the data, and as long as it plays out in line with expectations, we are fine. So we are not saying we are overly bearish on the market. It's just that given the state of the market, state of the economy, the state of the data points you're getting, it pays to be a little bit cautious at this juncture rather than being completely bullish. That is the way we are looking.
Fair point. How did you analyze the management commentary? I was just reading Mr. Shankar Raman's comments in one of the pink papers this morning saying that this entire PLI announcement of across 13 sectors is a total capex of around 22 23 billion dollars, out of which 11 to 12 billion dollars could be the EPC opportunity alone, which could present itself for large EPC players like L&T. When you speak to PSU banks, they are talking about the large scale provisioning perhaps now ending and period of write-backs perhaps starting, asset quality improvement and all of that. How did you analyze the quality of management commentary more than earnings this quarter?
I think two, three things coming out from management commentary. I think one is the margin pressure, given the input cost escalation. Some sort of a mixed view on growth. Some parts of the economy seem to be doing well, while others are not. So I would view it as a little bit of a mixed commentary rather than a completely bullish commentary. Having said that, yes, part of the PLI scheme, the fact that the bank's balance sheets have corrected, does put into place an enabling environment for growth. Is it sufficient for capex cycle to come back and growth to be very significant? I don't think so. It's a essential condition to have. Where the bank's balance sheets are definitely better, they can grow. But one has to be clear that we have not seen that kind of growth. The bank's balance sheets have been improving for a while, and that has been the market view as well. But still, the banks continue to struggle for growth. So it's a good starting point. Whether it will happen or not, I think time will tell, and we'll watch the data clearly. And hope that it happens, and we get into a multi-year growth cycle on the capex front as well as the overall economic growth front. But I would say it's a little bit early to kind of take that kind of a call. One is tempted when one sees the market and the mood it is in to take those kind of calls to justify the market situation at this point of time. But I would reserve my judgment, wait it out for a while. We remain positive, but at the same time cautious, and we'll continue to watch the data as it emerges.
The kind of earnings which have been reported so far, actual earnings, not forecast earnings for 22, 23 or 24, where do you find most valuation comfort in event of a healthy correction playing out? Which sector or some themes or some elements where you see quality of earnings much more durables, which may cushion the valuations?
We find the financial sector, especially the larger banks, actually quite comfortable on the valuation front as well as the overall growth prospects front. So, I mean, if one has to believe that some sort of a growth will definitely come back and the balance sheets are clearly improved, the provisioning numbers are going to be significantly lower as we go along over the next 2 to 3 years. So, and the valuations are completely are not out of league in terms of the historical valuation. They are still quite reasonable. And if I compare to the rest of the market, they look even more reasonable. So, larger banks, financials is something which we clearly like. I think there is then there are pockets. It's very difficult to really ascertain particular sectors. I do find valuations to be reasonably okay in the pharma sector. The sector hasn't really performed as well as one would like to, but at least the valuations are not completely out of the league as we see in some other sectors. So these are a couple of sectors where we see the valuations okay. And then there are stocks and individual companies where either the valuations in absolute levels are reasonable, or the valuations are reasonable at least in line with the kind of earnings trajectory those companies are likely to show. So there are pockets available, but within this entire market, clearly the most comfortable place does seem to be the financial sector at this point of time, especially the larger banks.
How are you analyzing the export opportunity beyond the legacy large players like pharma exports or even technology exports? When we speak, or even looking at the numbers, some of the textile companies, chemical companies, of course, is emerging area, but machinery exports, capital goods, and all of that appears to be little promising. Have you started looking wider into export opportunity plays beyond the traditional ones?
To be honest, no. I mean, areas like textile, machinery exports are difficult to play, given that most of the companies would be mostly in the small cap space, which does not necessarily fall into our radar. But yeah, that could be an interesting space if the trend continues on the export front, and we have seen some of the best export months in the last 6 months for India. And if that trend continues, exports continue to grow, and we get some more visibility, we'll probably look at it, but not so far.
Convinced are you from on the argument that this is a structural growth opportunity for the technology pack, and commentary was good, growth guidance has been up, things are looking okay there. Do you believe that another 2-3 years or at least few quarters the argument holds itself?
Does look like. I think we are seeing fairly broad-based growth in the technology sector. Both the mid caps and the large caps continue to deliver good top-line growth. And the margin pressure, while evident, has not been as bad as the market imagined it would be. And I would believe that if the demand remains reasonably robust, I think these companies will have enough pricing power to be able to pass on any margin pressure. On top of that, strong hiring in the sector should help alleviate some of those things as we go along, especially on the attrition side and eventually leading to the margin side. So, believe that at least for the next couple of years, the growth will remain strong. The question is now whether the valuations are already reflecting that or there is more to come. I think individual stocks have different kind of on different stocks, you have different kind of views there. So not a sector view, but clearly like some of the stocks within the sector, depending on what kind of growth trajectory and valuations we see.
So always enjoy chatting with you. Thanks so much for your time this afternoon
Thank you
as
so
well,
much.
talking about different areas of the market.